The dollar just had its worst 6-month performance in over half a century. While you were sleeping, something fundamental broke in the global monetary system. And the smart money? They're not panicking. They're quietly moving into position. Let me show you what's happening right now, because the implications are staggering. The US dollar index dropped 11% in the first half of this year. That might not sound catastrophic until you understand what it represents. This isn't just another dip in a volatile market. This is the end of a 15-year bull run, the longest sustained period of dollar strength since the Bretton Woods system collapsed. Think about that for a moment. 15 years of dominance, gone in 6 months. But here's where it gets interesting. While the dollar melts, gold and silver aren't just rising, they're exploding. Silver has more than doubled. Gold is up 66%, and these aren't speculative bubbles driven by retail investors chasing momentum. This is institutional accumulation on a scale we haven't seen since the 1970s. Central banks are buying gold at the fastest pace in recorded history, not slowing down, accelerating. They're converting their dollar reserves into physical metal at a rate that would have been unthinkable 5 years ago. When the people who print money start hoarding gold, you need to pay attention. The question everyone's asking is, why now? What changed? The answer is everything. For decades, the dollar's strength rested on 3 pillars. First, the petrodollar system that forced global oil trade through U.S. currency. Second, the absence of credible alternatives for international reserves. Third, the perception of American economic and political stability as an unshakable constant. All 3 pillars are cracking simultaneously. Saudi Arabia just let their 50-year petrodollar agreement expire. They're now accepting yuan for oil sales to China. The UAE is settling trades in rupees with India. Brazil and Argentina are discussing a common currency for South American trade. These aren't fringe economies. These are major players in global commerce, and they're actively building payment systems that bypass the dollar entirely. The BRICS nations aren't just talking about alternatives anymore. They're implementing them. Russia and China have reduced their dollar reserves by hundreds of billions. They're settling bilateral trade in their own currencies. They're building payment infrastructure that doesn't touch the SWIFT system, and they're backing their moves with gold. Here's what most analysts miss. This isn't about replacing the dollar overnight. That's not how monetary systems shift. It's about reducing dependence gradually, then suddenly. It's about creating optionality. And once that optionality exists, the dollar's monopoly pricing power evaporates. Think about what monopoly pricing power means in currency markets. When everyone needs dollars for international trade, the U.S. can run massive deficits without immediate consequences. Other countries have to hold dollars as reserves, which means they're essentially lending to America at artificially low rates. It's an extraordinary privilege that's funded decades of American consumption beyond what the economy actually produces. But privileges aren't permanent. They're contingent on circumstances. And circumstances are changing fast. The Federal Reserve is caught in an impossible position. They've raised interest rates to the highest real levels in 18 years. In normal times, that would strengthen the dollar dramatically. High rates attract capital flows. Investors around the world would be rushing to buy dollar-denominated assets to capture those yields. Except it's not working. Despite the highest real rates in nearly 2 decades, the dollar is collapsing. That tells you something profound about confidence. It tells you that investors are more worried about holding dollars than they are attracted to the yield. They're pricing in risks that go beyond interest rate differentials. What risks exactly? Start with the debt. America's national debt just crossed $36 trillion. The interest payments alone are now larger than the defense budget, larger than Medicare. The government is borrowing money just to pay interest on money it already borrowed. That's not a sustainable trajectory. That's a debt spiral. And here's the kicker. Those interest payments are being made in a currency that the government can print at will. Every other debtor in history has faced a hard constraint. They had to earn the money to pay back their debts. But when you owe debts in a currency you control, you have another option. You can inflate them away. That's not a conspiracy theory. That's monetary history. It's what happened in Weimar Germany. It's what happened in Zimbabwe. It's what happened in Argentina, Venezuela, Turkey. The pattern is always the same. Governments with unsustainable debts and control over the printing press eventually choose inflation over default. The difference is that America's inflation exports globally because the dollar is the world's reserve currency. When the Fed prints, everyone holding dollars gets diluted. That worked fine when there were no alternatives. But now, Countries are watching their dollar reserves lose purchasing power and asking themselves why they're holding them at all. This is where gold enters the picture, not as a speculative asset, as insurance against monetary chaos. Gold has no counterparty risk. It's not someone else's liability. You can't print it. You can't devalue it by decree. It's maintained purchasing power across millennia, while every fiat currency in history has eventually failed. Not most currencies. Every single one. The average lifespan of a fiat currency is 27 years. The dollar has been fully fiat since 1971 when Nixon closed the gold window. That's 54 years. We're already running on borrowed time by historical standards. But here's what makes this moment different from previous dollar crises: the scale of the response and the sophistication of the players involved. In 1971, when the dollar was devalued against gold, most central banks were caught off guard. They held massive dollar reserves that suddenly lost value, and they had limited options for diversification. The gold market was small and tightly controlled. Moving large positions was difficult without moving prices dramatically. Today's gold market is vastly deeper and more liquid. Central banks can accumulate thousands of tons without causing the kind of price spikes that would alert markets to their intentions, and they're doing exactly that. They're accumulating quietly, consistently, month after month. China hasn't reported their true gold reserves in years. Analysts estimate they're holding somewhere between 4,000 and 30,000 tons. That's a massive range, which tells you how opaque their accumulation has been. Russia has tripled their gold reserves over the past decade. India, Turkey, Poland, Hungary, Singapore, all buying aggressively. These aren't random purchases. This is coordinated de-dollarization, and it's accelerating. Now let's talk about silver, because something extraordinary is happening in that market that most people are completely missing. Silver has outperformed gold by a massive margin this year. It's more than doubled while gold is up 66%. That's unusual. Historically, gold leads and silver follows with higher volatility. When you see silver outperforming by this magnitude, it signals something specific: supply shortage. Silver has a unique position in the commodity world. It's both a monetary metal and an industrial metal. About half of silver demand comes from industrial applications: solar panels, electronics, electric vehicles, medical equipment. These aren't discretionary uses. You can't build a solar panel without silver. You can't manufacture electronics without it. And here's the problem: silver production is declining. Most silver comes as a byproduct of copper, lead, and zinc mining. When those base metal prices are low, mines shut down, and silver production falls with them. We're not opening new silver mines. We're closing old ones. Meanwhile, demand is exploding. Solar panel installations are growing exponentially. Electric vehicle production is ramping up. Every EV uses significantly more silver than a traditional car. The energy transition everyone's talking about? It's massively silver intensive. So you have declining supply meeting surging industrial demand. That alone would be bullish. But then you add investment demand on top. Investors are buying physical silver at record rates. Silver ETFs are seeing massive inflows. Mints around the world are reporting shortages of silver coins and bars. The COMEX, the major futures exchange for silver, is showing signs of stress. The amount of physical silver available for delivery has dropped to critically low levels relative to the open interest in futures contracts. That's a setup for a squeeze. When too many paper claims exist on too little physical metal, prices can move violently. We saw a preview of this in 2011 when silver briefly touched $50 an ounce. That wasn't driven by fundamentals. That was a short squeeze. Traders who had sold silver they didn't own were forced to buy it back at any price to close their positions. The price went parabolic. The difference between then and now is that the fundamental backdrop is far stronger today. In 2011, silver was purely a monetary play. Investors were buying it as inflation protection, but industrial demand was modest. Today, you have both monetary demand and structural industrial demand. That's a much more powerful combination, and the supply situation is worse. In 2011, there were large above-ground inventories that could be mobilized when prices rose. Today, those inventories are depleted. The silver that's being mined is being consumed immediately by industry. There's no buffer. This is why silver is outperforming gold. The market is starting to price in the reality of a supply deficit that could last for years. And when you have a deficit in a commodity with inelastic demand, prices have to rise until they destroy demand or incentivize new supply. Given how long it takes to bring new mines online, we're looking at a multi-year adjustment period. Let me put this in perspective with some numbers. Global silver production is roughly 800 million ounces per year. Industrial demand alone is about 600 million ounces. Investment demand is another 200 million. That's a 100 million ounce deficit that's being filled by drawing down inventories. How long can that continue? Not indefinitely. At some point, the inventories run out, and then what? Either prices rise enough to ration demand, or you get physical shortages. Industries that need silver to function start competing for limited supply. That's when prices can move in ways that seem irrational to people who don't understand the physical dynamics. Now, if you're sitting on significant retirement savings, this is where things get personal. Because the wealth you've accumulated over decades is denominated in a currency that's losing purchasing power, while the assets that preserve wealth are appreciating rapidly. Quick aside here. If you have $100,000 or more in retirement accounts, there's a strategy worth understanding. Gold IRAs allow you to hold physical precious metals inside your retirement account without triggering taxes or penalties. I put together a free guide that explains exactly how this works, what the rules are, and how to evaluate if it makes sense for your situation. It's in the description below. No obligation, just information. Worth checking out if you're concerned about dollar devaluation affecting your retirement. Back to the bigger picture, because what's happening with currencies and metals is just the surface. Underneath, there's a complete restructuring of the global financial system taking place. The Bretton Woods system that established the dollar as the world's reserve currency was created in 1944. It lasted until 1971, 27 years. The current system of floating fiat currencies backed by nothing has lasted 54 years. We're due for a reset. What does a reset look like? History gives us clues. In 1944, the winners of World War II gathered and decided the rules. The dollar was pegged to gold at $35 an ounce. Other currencies were pegged to the dollar. It was a gold-backed system with the dollar as the intermediary. That system broke down when America printed more dollars than it had gold to back them. France called the bluff and started demanding gold for their dollars. Nixon closed the gold window rather than deplete America's gold reserves. And we've been in a pure fiat system ever since. The current system is breaking down for similar reasons. America has printed more dollars than the global economy can absorb without inflation. Other countries are calling the bluff by reducing their dollar holdings and buying gold. The difference is that this time, there's no single dominant power that can dictate the new rules. China's economy is now comparable in size to America's. The European Union is a major economic bloc. India is rising fast. This isn't a unipolar world anymore. It's multipolar. And in a multipolar world, no single currency can serve as the universal reserve without the backing of something tangible. That something is likely to be gold, not a return to a strict gold standard where currencies are directly convertible to gold at fixed rates. That's probably not politically feasible, but a system where gold serves as the neutral reserve asset that settles imbalances between countries, where central banks hold gold as their primary reserve and use it to back their currencies partially. We're already seeing moves in that direction. The BRICS nations are discussing a new currency for international trade that would be backed by a basket of commodities including gold. Russia has proposed settling energy trades in gold-backed instruments. China is encouraging gold accumulation by its citizens and institutions. These aren't random policy experiments. This is preparation for a new monetary architecture. And if you're not positioned for that transition, you're going to watch your purchasing power evaporate. Let me tell you a story that illustrates what's at stake. In 1971, when Nixon closed the gold window, gold was $35 an ounce. By 1980, it had reached $850. That's a 2,400% increase in 9 years. People who held gold preserved their wealth. People who held dollars lost 80% of their purchasing power. But here's the part that's less well known. The real gains weren't made by people who bought gold at $35. Most people didn't see it coming. The real gains were made by people who bought between 1974 and 1976, after the initial spike, when gold had pulled back and everyone thought the crisis was over. Gold dropped from $200 to $100 in that period. The mainstream narrative was that inflation was under control, the dollar was stabilizing, and gold was a bubble that had popped. People who believed that narrative missed the entire move from $100 to $850. We might be in a similar moment right now. Gold and silver have had massive runs. Some people are saying they're overbought, due for a correction, too expensive to buy now. But if we're in the early stages of a monetary regime change, these prices will look cheap in hindsight. The key is understanding the difference between price and value. Price is what you pay. Value is what you get. Gold at $4,000 an ounce might seem expensive compared to gold at $2,000. But if gold is going to 10,000 or 20,000 as the dollar loses reserve status, then 4,000 is cheap. How do you think about valuation for gold? One method is to look at the ratio of gold to the money supply. In 1980, when gold peaked at $850, the ratio of gold price to M2 money supply was at an extreme. Today, even with gold at $4,000, that ratio is nowhere near the 1980 peak. Why? Because the money supply has exploded. The Fed has printed more money in the past 5 years than in the previous century combined. That's not hyperbole. That's data. And all that money is chasing a relatively fixed supply of gold. Only about 3,000 tons of new gold are mined each year. That's roughly 2% supply growth. Compare that to money supply growth of 10 to 20% in recent years. When you have 20% growth in money chasing 2% growth in gold, the math is straightforward. Gold's price in dollar terms has to rise to reflect the debasement of the currency. It's not that gold is becoming more valuable. It's that dollars are becoming less valuable, and gold is the measuring stick that reveals it. Silver has even more compelling math. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been compressing. It peaked at over 100 to 1 during the COVID crash. Today it's around 60 to 1. The historical average is around 50 to 1. If silver continues to outperform, and that ratio compresses to 40 or 30 to 1, the price implications are enormous. Let's say gold goes to $6,000 an ounce over the next 2 years. That's a 50% increase from current levels. If the gold-to-silver ratio compresses to 40 to 1, silver would be $150 an ounce. That's a tripling from current levels. If the ratio goes to 30 to 1, silver hits $200. That's a 400% gain. These aren't wild speculations. These are scenarios based on historical precedent and current supply-demand dynamics. The ratio has been as low as 15 to 1 in the past. If we see anything close to that, silver could go to $400 or higher. But here's what you need to understand about these moves. They don't happen in straight lines. There will be violent corrections. There will be moments when it feels like the trade is over. The media will declare the bubble has popped. Weak hands will sell. And that's when the next leg up begins. This is why physical ownership matters. When you own physical gold and silver, you can't get shaken out by margin calls or forced liquidations. You're not worried about counterparty risk or exchange failures. You can hold through the volatility because you understand the long-term thesis. Paper gold and silver, through ETFs or futures contracts, can be useful for trading, but they're not the same as physical ownership. In a real crisis, when everyone wants to convert paper claims to physical metal, you'll discover that there's not enough physical to go around. The paper price and the physical price can diverge dramatically. We saw this during the COVID crisis in 2020. Gold ETFs were trading at $1,700 an ounce, but try buying physical gold coins. Dealers were charging $200 to $300 premiums over spot. The paper price was meaningless if you couldn't actually get physical metal at that price. That premium tells you something important. It tells you that physical metal is scarcer than the paper market suggests. It tells you that when stress hits the system, people want the real thing, not a promise to deliver it later. This is especially true for silver. The silver market is much smaller than gold. Total above-ground silver inventories are estimated at around 2 billion ounces. That sounds like a lot until you realize that's only about $100 billion worth at current prices. Apple's market cap is $3 trillion. The entire global silver inventory is worth less than 4% of one company. What happens when a tiny fraction of global wealth tries to move into physical silver? The price has to rise dramatically to ration the limited supply. And unlike gold, which is mostly held as a store of value and can be recycled, silver is consumed in industrial applications. Once it's used in a solar panel or electronic device, it's effectively gone. It's not economical to recover it. This consumption dynamic means that silver inventories are being permanently depleted. Every year, hundreds of millions of ounces are consumed and not replaced. At some point, that becomes a crisis for industries that depend on silver. And when industries start competing with investors for limited supply, prices can go parabolic. Think about what happened with palladium a few years ago. Palladium is used in catalytic converters for cars. When supply got tight due to production issues in Russia and South Africa, the price went from $500 an ounce to $3,000 in just a few years. A 600% increase driven purely by supply-demand fundamentals. Silver has similar dynamics but with a much larger potential market. If solar installations continue growing at current rates, silver demand from that sector alone could exceed total annual production within a few years. Add in electric vehicles, 5G infrastructure, and investment demand, and you have a supply crisis in the making. The smart money understands this. That's why silver is outperforming gold. That's why premiums on physical silver are elevated. That's why mints can't keep up with demand. The market is starting to price in a future where silver is genuinely scarce. Now let's connect all these threads. The dollar is losing reserve status. Central banks are accumulating gold at record rates. Silver is facing a structural supply deficit. Interest rates are at 18-year highs, but the dollar is still falling. Inflation is proving stickier than expected. Geopolitical tensions are rising. Trade wars are fragmenting global commerce. Every one of these factors points in the same direction, toward a world where hard assets outperform financial assets, where tangible wealth beats paper wealth, where gold and silver reassert their 5,000-year role as money. This isn't about getting rich quick. This is about preserving wealth through a monetary transition. It's about making sure that the purchasing power you've accumulated over a lifetime doesn't evaporate in a currency crisis. History is littered with examples of people who thought their wealth was secure because it was denominated in the dominant currency of their time. The British pound was the world's reserve currency for 2 centuries. Then it wasn't. People who held pounds through that transition lost most of their wealth. People who held gold maintained their purchasing power. The same thing happened with the French franc, the German mark, the Japanese yen. Every reserve currency eventually loses that status. And when it does, the adjustment is brutal for people caught on the wrong side. The dollar's turn is coming. Not tomorrow, not next month, but the process has started. And once these transitions begin, they accelerate. Slowly at first, then all at once. You can see it in the price action. Gold and silver aren't moving like normal commodities anymore. They're moving like monetary assets. They're responding to currency debasement, not just supply and demand. They're being accumulated by institutions that understand what's coming. The question isn't whether to own gold and silver. The question is how much. And the answer depends on your situation, your risk tolerance, your time horizon. But if you have zero exposure to precious metals right now, you're making a bet that the dollar maintains its dominance indefinitely. That's a bet against 5,000 years of monetary history. Think about your portfolio allocation. If you have $1 million in retirement savings and 10% is in gold and silver, that's $100,000. If gold and silver triple over the next 5 years while stocks are flat or down, that $100,000 becomes $300,000. That's a $200,000 gain that offsets losses elsewhere. But more importantly, it's insurance. It's the part of your portfolio that goes up when everything else is going down. It's the asset that maintains purchasing power when currencies are being debased. It's the wealth preservation tool that's worked for millennia. The dollar is melting, not metaphorically, literally. Its purchasing power is eroding in real time. The question is whether you're going to freeze your wealth in metal before the melt accelerates, or whether you're going to watch your savings evaporate in a currency that's losing its privileged position in the global system. The smart money has already made their choice. Central banks are buying gold by the ton. Billionaires are accumulating silver. Institutions are positioning for a monetary reset. They're not waiting for confirmation. They're not waiting for the mainstream media to tell them it's safe. They're acting now while prices are still reasonable. Because once this transition becomes obvious to everyone, once the dollar's decline accelerates into a crisis, it'll be too late to position. Premiums will explode. Physical metal will be unavailable. You'll be trying to buy at prices that are multiples of today's levels. The time to act is when it still feels early, when people are still debating whether this is real. When the mainstream narrative is still that everything is fine, that's when asymmetric opportunities exist. That's when you can position for massive gains with limited downside. Gold and silver aren't going to zero. They've been money for 5,000 years. They'll be money 5,000 years from now. The dollar? It's 54 years into an experiment that's never worked in human history. Every fiat currency fails eventually. The dollar won't be different. The only question is timing. And while no one can predict exact timing, the direction is clear. The trend is established. The fundamentals are overwhelming. The technical picture is bullish. The sentiment is shifting. The smart money is positioned. Are you?